Sorry lads, I don't know what happened there. I was teaching away and I noticed that the video had stopped recording. Okay, so I put these up as two separate videos. Okay, so the revaluation, depreciation of buildings. If you look at this here lads, you can see that it's all included in one working. So might as well just do it as one working. It says here the company revalued land and buildings at 975,000 on the 1st to 1st. And notice that the accounts is actually for the 31st of 2018. So they did at the start of the year. Okay, so that means at the start of the year the buildings were worth 975,000. Okay, not the 850,000 that you see in the trial balance. Okay, and the land element of this value is 150,000. You want that land value because when you're calculating depreciation, it's just on buildings. Now the revaluation we can leave to the second part of this working. So the easiest thing to do here, lads, okay, is to do depreciation. Now remember, it's on the 975,000. Okay, let's subtract the land worth, which is 150,000. Okay, and you get 825,000. Okay, multiply that by 2% and you get 16,500. Okay, so that's your depreciation on buildings, and as we know, okay, that's an admin expense in your P&L. Okay, and it'll also go into your fixed assets in your balance sheet. Okay, that's all that was to that. Now, the revaluation reserve, we're used to doing this, okay, at the end of the year, but this was done at the start of the year, right? So that means that if you go back to your trial balance there, you'll see that the cost of buildings and land was 850,000. Okay, and because the depreciation was done at the end of last year, and this year accumulated depreciation is 55,000. Okay, it's actually easier because there's no depreciation for this year included in this revaluation reserve. So that means when you're revaluing the land and buildings, okay, you had your net worth for land and buildings was 795,000, right? And then you revalued them at the beginning of the year, at the end of the year, last year to 975,000. That means the difference between these two was quite simply your revaluation reserve, which in this case here is 180,000. Okay, and we know that goes into your finance by, okay, in your balance sheet. All right, that was that workings there for your evaluation and your depreciation in buildings. Okay, now the next working, lads, is the bank working. Okay, so we've got our own bank. Okay, versus the bank statement. Okay, so let's have a look at this here. So the first thing it says is a check received. Oh, sorry, my apologies. I should put down the overdrafts. So the bank statement gave us an overdraft of 62,280, and our own bank account has an overdraft of 60,000 euro. Okay, now it says here a check received from a debtor for 5,600 had been dishonoured by the bank. Okay, so we weren't aware that that was dishonoured. The bank is aware, so it's been taken care of in the bank statement, but we weren't aware of that. Okay, so that means, okay, that it's an additional or a negative 5,600 because the money that we thought we got off a debtor reduced our overdraft. We found out that that check is bounced, so we now must increase our overdraft once again. But look at the next part of it. It says this debtor has been declared bankrupt, but they've made a credit transfer, which we are unaware of, okay, of 30 cents for every euro owed. So they owe us 5,600. So multiply that by 30%, and it gives us 1,680. So that's going to reduce our overdraft. Okay. A direct debit to a local refuse is the second part of this now. A direct debit, so to a local refuse company. Okay, so we're given a direct debit to a local refuse company for 860 had not been recorded. So that's an 860 paying out, so that's going to increase our overdraft. Okay. These two here will be done in one working, all right, and this here will be done in a separate working. Okay, a check for fees for 2,500 issued to director have been not presented for payment. So that means that's simply an additional 2,500 that the bank is not aware of. Okay, let's see if these two add up. All right, so we've got a negative 60,000 to start on our own bank account. We minus 56 from that. We'll add the 1,680 and we'll minus 860 from that. Okay, and we get 64,780 as an overdraft. Okay, and then go to the bank statement. We have a negative 62,280 minus an additional 25, and we have, yep, okay, the same. So 64,780. Okay, so let's circle this here, so we know that's going to be a current liability for our bank. All right. So let's deal with this working here in regards to this debtor. Okay. So that 5,600, okay, is a total debt. Okay. So that's a total debt. Okay. We've already taken away from our debtors. Okay. Because we've done it previously, if I'm correct. Let me think about that for a second now. Yeah. So that 5,600, we received a check from them for that. All right. And we already wrote that off from our debtors. Okay. So therefore we don't take anything else away from the debtors. That's a tricky one actually when I think about it. Okay. So let me explain that again. So that 5,600 you originally received in a check form from that debtor. For you to deal with that, you would have gone to your bank account, you would have added 5,600 to it, and you would have taken away 5,600 from your debtors. It then came to your attention that that 5,600 was dishonoured, okay, but you hadn't been aware of it until now, okay, and at the same time then you received a credit transfer, all right. So we've already taken that 5,600 away from the debtor, but we've got a little case then of that we're down money here. We're down 70% of that 5,600, so that's the bad debt. So all that's required here, lads, is a simple working actually when you think about it. Okay, it's working 17, and it's bad debt. Okay, and that bad debt, lads, is 5,600, okay, times 70%. Or you could just subtract 1,680 from it, okay. So 5,600 multiplied by 0.7 gives us 3,920. Okay, and that is your bad debt, lads. Now that will go in as a selling and distribution expense. Okay. That's that working taken care of. Alright. Now, the next thing we need to take care of is that 860. So a direct debit to a local refuse company for 860 had not been recorded in the company's books. As far as I'm concerned, lads, I don't think there's much to do that except just to make note of it, that it has to go in as an expense. Okay, in your P&L account. Alright. Let me think about that for a sec now. That 860. A direct debit to a local refuse company had not been recorded in the company's books. Yeah, so we need to record it as an expense, okay? Now you can put it, you can put it in as a refuse expense in the admin expenses, or you can add it to general salaries and general expenses. Either way, it would have been completely fine. I think we have salaries and general expenses open already, so I'll just add it into that actually. Okay. So where is it? There it is. Okay, so let's simply add, because it's taken care in the bank account, so we just add that 860 onto the salaries and general expenses. Okay, and that takes care of that refuse bill. Yeah, that's what you would do with it. Okay, I'm happy enough with that. Okay, so that's working 17 taken care of. Okay, nearly there, lads. Alright, long old question this now in fairness. Okay, working 18. Okay, provision should be made for investment income due and debenture interest due. Thankfully we have done that. Okay, provisions for bad debts to be adjusted to 4% of debtors. Okay, so provision for bad debts. We need to go and get our debtors figure. Okay, I believe we've opened it somewhere. There we go. Okay, so obviously I can close this off here now. So 98,200. Okay, minus 7,500. Okay, let's do that in the calculator there. Alright, it's 90,700. Okay, and as we know, that's the current asset. I'll come back and close all these off in a second anyway, but we need that figure now. So 90,700. Okay, so 4%. So 90,700 multiplied by 0.04 gives us 3628. Okay, how have we got an old provision? We do. Okay, the old provision was 4,000. Right, so let's just circle this for a sec. Okay, we know that's going to go into the balance sheet and take it away from our current assets with debtors. Okay, the old provision was 4,000. The new provision is 3628. The difference between those two is 372, I believe. Okay. And that there, lads, is a gain. Alright. And that's that working done. Okay, working 19. Okay, the managing director should be paid a bonus of 5% on all sales. Okay, well, let's get our sales figure. It's up here somewhere. There it is. Okay, so now we can close off the sales. Okay, so 1590000 minus 7,500. Okay, gives us 1,582,500. Okay, we know where that's going to go. That's going to go into your trading account. Okay, so let's bring that figure down here. So this is commission. Okay, the sales figure from up there was 1,582,500. Okay, minus 1,200,000. Okay, and that gives us 382,500. Multiply that by 5%. Okay, I get 19,125. Okay, so that there is going to be selling and distribution expense, as it's based on sales. Alright, and then a transfer of 10,000 should be made from the profit to the capital reserve. No need for working on that, gents. Okay, we can just do that in the actual figures itself. So what you'd be doing with that is you would take 10,000 from your net profit. You can do it when you're taking away your dividends as well. And then when you're adding your capital reserve that you see there at the very bottom of the trial balance, you have a capital reserve there of 45,000. So you'll add 10,000 to that, okay, which is going to be 55,000, which will go into the balance sheet. Okay, gents, I hope that is helpful. Okay, there was quite a bit involved with that question, a lot of new workings there, lads. Okay, what I'll do so is I'll post these solutions ads and give you more work to do until Friday.